Hey, welcome to Retire Mentorship Live. My name is Freeman Lindy. I am a certified financial planner and tax advisor. I work with folks in Wisconsin, Minnesota, and all over the country to help them retire successfully and stay successfully retired. Help dozens of people. It's all I do is people kind of 5 years or so from retirement moving on. And what we want to find out today is, should people like you or anyone else who's watching this, should they contribute to a Roth IRA? So I've been doing this YouTube channel for a while. We're now live every Wednesday at 4 p.m. Central. So if you want to join us live, you can. You can then use the chat feature if you want. You can ask us questions, which we'll answer at the end. So each show, we're going to have the main topic right off the bat. Then we'll get into some Q&A. There'll be some other segments that we'll add throughout time as the show progresses. But if you have questions, you can put them right in the chat. So if you want to show up live, you can get your question answered that day. Or if you want to email us questions, you can send those to questions@retirementorship.com, and we'll filter through those and we'll pick some for each week to answer on the show. If you miss the show, it'll be posted right to YouTube afterwards. You can find it there. It'll also be, the audio will be posted to different podcast platforms and the video as well. You can actually watch the video on platforms like Apple Podcasts and whatnot. So be sure to check those out. Give us a like and subscribe if you want more of this content. But otherwise, we will dive into the content today. Question before us: should I contribute to Roth or traditional in 2026? With all the rules that have come down with the IRS law changes, what's the strategy? What's the best thing to do going forward? We had the One Big Beautiful Bill Act that came out over the summer. That's compounding on top of changes that are going into effect from Secure Act 2.0 and the Inflation Reduction Act and all these other things. And so, hey, going forward, what's the best thing to do? Should I contribute to Roth or traditional? And that's what we want to dive into today. So a couple things that we want to cover with that then. Let me pull up my quick things here. All right, so you're going to want to make sure, first I want to do is I want to cover some basics, and just so we make sure we're on the same page of how all these things work. But you want to stick through to the end because that's where the complications and the changes and those kind of things are going to show up. And so that's where it's really going to get tactical. But for now, let's jump right into our little buckets diagram here. So I've got my trusty iPad, and actually I think we can use, let's just use this guy here. There we go. So if you probably know this, right? But there's 4 main types of accounts that we can have in that we can save into. The first type is broadly just traditional accounts. It'd be like traditional IRA, traditional 401k, that type of stuff. And then we've got non-qualified or just brokerage accounts, some people would call them, or some of those types of things. We've also got Roth and HSAs have their own category. And the main way that we think about these is, again, they can have different things inside of them. You can have a Roth IRA at a bank. You can have an HSA at a bank. Or you can have it invested at a custodian like Vanguard or Schwab or Fidelity. And so what's inside of it, whether it's mutual funds or whatever, that's separate. That's your asset allocation, your investment mix. We're just talking about the account types, how they're treated for tax purposes. And so for a traditional 401k IRA, we always look at, hey, what are contributions? What happens while it's in the account, while it's growing, and what happens when it's deferred. And so on a traditional account, of course, your pre-tax, your accounts go in there pre-tax, right? That's where it is, you haven't paid any taxes yet on that money, and it's going to then come back to you, or you haven't paid on taxes, or maybe it's tax deductible. And then as long as it stays in the account, it's tax deferred. And then when we pull the money out, that's when you're going to pay the tax, right? You then have Roth accounts where it's kind of the opposite. You contribute to those accounts with after-tax dollars. It then grows. As long as it's in the account, it's going to grow tax-free or tax-deferred. And then when you take it out, it'll be tax-free if you follow all the different rules. One second. Okay, so guess we're not having my fancy screen share was not working there, so we'll do this the old-fashioned way. But we have right, those grow tax-free. Now there's some asterisks on there, right? You have to be 59 and a half, have to have it for 5 years, a bunch of those things. So make sure you follow all those rules. But in general, that's how that works. Then you've got your non-qualified accounts. or non-retirement accounts, right? That's going to be after-tax money. So that's obviously money you've already paid taxes on. That's how you contribute to that account. It then grows taxably. So as it earns interest, capital gains, and dividends, you'll pay taxes on those every year. And then when you sell things to pull it back out, you will then pay taxes on the gain on those sales, right? So it's kind of triple taxed. You can, if you really want to get really fancy, there actually are some cool tax advantages to these types of accounts that we won't get into today, but that's generally how those ones work. And then you've got the fancy HSAs, right, which you can put in money pre-tax or tax deductibly into the HSA. It grows tax deferred and can be used tax-free for healthcare. Again, a bunch of asterisks on that. So that's the best type of account. But really, we want to focus on, hey, for our main retirement contributions, either those done through our 401ks, 403bs, things like that, or if we're trying to fund IRAs afterwards, which ones do we want to do? And so real quick, before we move on to that, I first want to cover, right, the different contribution limits. If we're contributing to these accounts over the course of this year, how does that work? All right, so we've got our 401ks, traditional 401k, Roth 401k. Your contribution limits for 2026 are about $24,000, right? If you're over age 50, you can do $8,000 on top of that. And for just a few years here, if you're between the ages of 60 and 63, that means you turn that age in the year. So if this year you're going to turn 60, or you're going to turn 61, 62, or 63, then you can do this. If you are 60 now, or if you're, if you're 63 now, but you're turning 64 this year, you're out of it, right? So it's the year you turn one of these ages. That bonus contribution turns into a super bonus contribution, and that actually goes up to $11,250. Now, this asterisk here for the super bonus is because not everyone can do it. If your plan allows it, you can, and if it doesn't allow it, then you can't. So it's a plan-specific one. The other thing with this one, this asterisk here, is if your income last year in 2025, your earned income, your income subject to FICA, so not the stuff that's on your tax return, the stuff that's in your W-2, if that was over 145, then any catch-up contribution you make, you can't do it into a traditional 401k. That must go into Roth. Basically, they're saying, hey, if you're high income and you're trying to write all that income off so you can pay taxes on it later, we're actually going to force you to pay some of the taxes now at those higher incomes. A workaround for this, though, is that starting a couple of years ago, maybe, you actually can get, right, so most of the time when we're putting money into our 401ks, whether we're doing into traditional or whether we're doing into Roth, employer matches, our employer match, that's going into traditional because your employer wants the tax write-off. But if your plan allows it, you can, if you want, send that employer match into Roth. It will get added to your taxable income for that year, so you will need to pay the taxes on the employer's contribution, but you can do that. And so if your employer is matching you a bunch of money, then you could say, hey, I can't do this into traditional anymore. I have to do into Roth, but I could also get even more money into Roth by paying the employer, getting the employer side in there as well. So again, you might not want to do that if you're high income. You might want to push it in traditional, but they're kind of trying to push more and more people into doing Roth so they can get current day income. Of course, if you're already doing Roth, that limit doesn't apply. For IRAs, right, smaller contribution limit that did go up this year for 2026 from $7,000 to $7,500, and the catch up, if you're over 50, went up by an extra $100. It's always been $1,000 for a long time, and it's now $1,100. Okay, so most of you probably knew those things, right, already. And so which one do you choose, right? How do you know if you should choose traditional versus Roth? And that's where we want to, first I want to show, hey, here's a simple version, right? The simple strategy for getting this done. And then we want to look at a more complex strategy because there is more to it than just what we're going to show. But this is how a lot of people think about it. So first of all, we got to know the tax brackets, right? And so the way the tax brackets works, we got 2026 now, we'll come back to this later, is for married filing jointly, just cut these brackets in half if you're single, basically. On the first $32,000 of income, you're going to pay you're going to pay 0% in taxes because you have a standard deduction, right? You might pay 0% on a lot more than that if you have more deduction, but minimally, that first $32,000, you're not paying anything. And then from 0 to $24,800 in taxable income, you'd pay 10%. And then anything over that, up to 100, basically 100,000, you'd pay 12. Then up to 211, you'd pay 22, etc., all the way up, right? And you also have capital gains. If you have, if you sell things and make a profit on that, you have qualified dividends. Those are taxed at 0% to pretty much the same amount. I think it's like 99,000 and some change, but pretty close to the same bracket change there. And then for a bunch of other gains, you pay 15% on those capital gains. So we need to know what those brackets are, where they are, in order to do this. So we'll come back to this in a second, but let me give you an example as we're thinking about contributing to traditional versus Roth, right? Let's say that we're talking about, hey, what should we do per $1,000 of contributions? We have a gross amount of $1,000, and we're trying to decide, hey, I know we're going to earn this in my paycheck. Should I put it into Roth 401k or traditional 401k, right? And what we want to think about is what taxes are we paying now versus what taxes will we be paying then, right? And so let's say that now the tax rate is 25%. There isn't a 25% tax bracket right now, but I'm trying to make the math simple. So let's just say it's 25%. And so on a traditional, would you pay any taxes now? No, because again, right, this is all traditional stuff goes in pre-tax. So you wouldn't pay any taxes on that. And so your taxes now would be 0. Taxes on the Roth, since that goes in after tax, you would have to pay those taxes, right? And so that'd be $250. And so what we could actually contribute now is we could contribute $1,000 to traditional, and we could contribute only $750 to Roth, right? Because we had to pay the taxes on it. And then that's going to double over some course of time. And so let's say it doubles to $2,000 over 5 years, 10 years, whatever, however long it takes. That depends on how you invest it. And so 1,000 would double to 2,000, 750 would double to 1,500, right? And now we need to pull it out. And again, this is where it depends on what are the tax rates going to be when we need to do that. And so let's say that the tax rates are 25% still. Okay, great. So we are going to withdraw the 2,000, right? And the 1,500. And we pay 25% taxes. So 25% on 2,000 is $500 in taxes. Do we pay taxes on pulling money out of the Roth? Assuming we've checked all the boxes, no, we do not. And so we will pay 0% on that Roth distribution. And at the end of all of that, we will have $1,500 out of the traditional and $1,500 out of the Roth. It's the same, right? So the first way to think about that is if tax rates, tax brackets, all that thing are the same between now and later, it doesn't matter. It's going to be the same result, okay? But what if we said, okay, tax rates are, well, I guess here's a question for you, right? Do we think tax rates are as low as they've ever been? If you look back at these tax rates, like the rates themselves are lower than they've ever been. And the amount of money that you can get in each bracket is rather large. And so do we think that in the future, taxes are going to go up, down, or stay the same? And I would say, well, they're probably not going to go down anymore, right? That's probably just not happening because they're already as low as they can get. And so they're either going to stay the same at best or they're going to go up at worst, right? And so one of the things you might look at is, hey, just straight rate changes, what's going to happen? Because if we said, hey, this is actually now 30% later, well, 30% of 2,000 would be 600. And so now you'd only get 1,400 out of here. And 30%, and we'd pay no taxes on the Roth. And so we would get 1,500. And so if tax rates are going to go up later, we'd be better off doing Roth. But if taxes are going to go down, either the rates change down, which is unlikely, or the actual tax goes down. And let's say that it's instead of, I guess this is always 0. Instead of 30% later, let's say it's only 20% later. Well, 20% taxes on 2,000 is 400, and you'd get 1,600, which is more. And so in that case, traditional would win. So if in the end, right, if taxes later are up, you do Roth. If you think tax rates are going to be down, then you do traditional. That's the simple way of thinking about that. And so one way you might look at this is say, where am I now, right? With my taxable income from 2025, what tax bracket am I in now? And you might be, hey, if you are here now in 2026, and let's say this is retirement. So we don't know when exactly this is. Maybe for you, it's next year, 5 years out, 10 years out, whenever that is. And so whenever that is, in 2020 something, 2030 something, maybe you're here right below this tax bracket now at 22%, right? And later on in retirement, you think, or maybe you're here, let's say, and you think in retirement that you can actually spend less and you would be down below this tax bracket. Well, in that case, do I want to do traditional and avoid paying taxes at 22% to pay 12 later? Yes, I do. Do I want to do Roth and pay taxes now at 22% just so I can avoid paying taxes later at 12? Probably not, right? And so if we were here and we think we're going to end up here, we are probably better off doing traditional, right? Write off the higher rate and pull that out later at the lower rate instead, right? If you were here and you thought you were going to be here, actually, let's look at a different one. Let's say that you are, so that would be a case for doing traditional, right? You're right above a bracket and you think you can get below it later. You'd want to do traditional. If you were early on in your career and you're like, hey, my income is now here, but later on, I think it's going to be way up here and I plan to retire in here. Well, then again, we'd want to do Roth because I'd rather pay taxes at 22 to avoid paying them or I'd rather pay taxes at 12 to avoid paying at 22% later, right? Or if I'm in 22, I'd rather pay them at 22 to avoid paying 24% later, right? And so again, just rule of thumb, if you're under 40 and you're retiring at a normal late 50s, 60s, you should probably be doing Roth because is your income going to go up, down, or sideways? Well, it's probably going to be up high. It's probably going to be higher later in your career. And so you'd want to reserve any traditional contributions for that point in your career. And so usually if you're beginning of your career, 20s, 30s, you'd want to just do Roth. Again, just from the simple strategy. You still might not want to if you get more complex, but in general. But what happens, so it's pretty obvious, like if you're in the bottom of a tax bracket now and you think you can be lower later, you do traditional. But what if you're going to be top of the 22 now and still think you'll be in the 22% later, right? Because then again, does it matter if the tax brackets are the same? Isn't it? Doesn't it? Isn't the result going to be the same? So who cares? In that case, I would probably skew towards doing Roth contributions because it gives you the most flexibility later, right? Because again, rates might go up. But the other thing is there's a lot more complexity down the road, and that's what we want to investigate. So for some of you, you're in a high, you're in 24, you're in 32% tax bracket now, and you think you can get your income way lower in retirement. And so you're doing all traditional now, and then you'll take it out later because you're like, well, I can still stay under the 22% tax bracket later. And so I'd rather save 24% now and pay 22% later. Not necessarily. And this is where we get into the more complex version of tax planning. Isn't tax planning fun? Where we say, okay, there's more than just the normal brackets, right? So here's the more complex version. We have all the normal brackets we just talked about, but then you also have all these sub brackets in here, all these dotted lines, right? This one right here, well, first of all, one complication is that some of your brackets, some of your information is based on what your taxable income is for the year, and some of it's based on your adjusted gross income. So that's confusing. And for some of these things then, like 150, you see this first line up here, $150,000, and then a purple line. That's a phase out. Means for every dollar you make going into this, something happens. And this is like very common phase out thing. They did this a lot with some of the COVID stimuluses. It was the exact same phase out range. Currently, they're doing it for the senior bonus deduction, which is an extra $6,000 per person over the age of 65. But it phases out when your AGI starts going over 150. Right? And so for every dollar it goes up over that, they reduce the deduction by like $1.06, I think. So by the time you get to 200,000, you get no senior bonus deduction, right? And then at 218 and 274, all these other ones, that's where you have your IRMA, which is your income-related Medicare adjustment amount, and that's where they charge you more on your Medicare. So this would only apply to people who are over 65 or who will be 65 soon, but they charge you more on your Medicare based on your income. Right. And so you might say, well, hey, I'm just trying to stay below the 22% tax bracket. But then you are over this IRMA and you are completely phased out of this thing here. And so even though technically, the difference between this amount and this amount is still 22%, as you go up in income here, you are actually paying something like 30-something% on each additional dollar because you're phasing out of this deduction along the way. And so, right, if we said, oh, well, hey, I want to do traditional now at 24 so I can pay 22 later. Well, hey, you might be avoiding paying 22 now only to pay 35 later as you phase out of this whole deduction. And so it's not that simple. It's not just as simple as just pick the bracket you're in and will you be in a lower bracket later or not. Again, all these IRMA things matter a lot. And this is, right, if you go a little bit over the 22, say you do a Roth conversion or you get a bonus or something, you go a little bit over the 22 into the 24. It's not that you get taxed 24% on all your income for that year, right? It's only on the amount that goes over the threshold. Well, with these IRMA brackets, if you go over a penny or a dollar, technically, because they always round off to $1 on tax returns, you pay the whole IRMA surcharge, right? Which is like $1,200 or something like that per person for the year, right? And it's only for that year. And if you go back under it the next year, your Medicare prices will come down. But at the same time, if you do hit it, well, then you might as well go all the way to the next bracket because you're already paying that, right? Then you've got the 250 here. That's where things like net investment income tax kick in. And so if you have capital gains, dividends, all these things, you pay extra taxes. It's not just the 15%. You actually pay an additional 3.8% on that. And so you have that to consider. And then, so yeah, phase outs, IRMA, capital gains, the difference between taxable versus AGI. And the last one, and this isn't in the brackets here, but your Social Security, right? If you're claiming that or are going to claim it, you will claim it at some point, right? The amount of that that's taxable is based on your other incomes. And so again, you might be at the point where, hey, technically, yes, I'm staying in the 12% tax bracket. So I'm gonna do traditional now at 22 so that I can live in the 12% later. But the not having Roth may make more of your Social Security taxable, and you may be paying actually a much higher effective rate on those changes with what it's doing to your Social Security than before. And so all those things really get into it. And then we go into the whole thing of if you do so much traditional because you think you're going to live in a lower tax bracket later, and a lot of people do. I see this a lot with retirees. They actually do. They earn in the 22 or the 24 or the 32, and then in retirement, they're at a lower tax bracket. Hey, I'm sticking around on the 12. This is great. And then you get required minimum distributions, right? Age 73 to 75 for most of you, which is, hey, your IRA's gotten too big. They're going to make you take money out of it. It's usually more than you wanted to. And most of the time we see those push people up into higher tax brackets than they wanted to be. And so we'll cover next week, actually. So this is kind of the contribution side of it. We'll cover next week, should we do Roth conversions? And so if you kind of want the back side of that, tune in next week. Again, you can tune in live if you want to be able to ask questions, or you can watch the replay. But that is going to be part of it too then. Hey, maybe I can't do enough Roth contributions. Should I be doing conversions? So we'll hit that side. So all this gets pretty complicated. Again, the simple answer is if you're going to be in a lower tax bracket later, you could do traditional now. But if you've already done too much traditional, you might need to do Roth. And depending on where you're at in all the complex tax brackets, you might be better off doing Roth. And so there is a specific answer for you. You know, there's always a question, should I do Roth or traditional? It depends. And yes, it does depend, but there is actually a mathematically superior optimal answer for you. I don't know what it is because I don't know your situation, but we can find out. So you can, again, continue to learn, tune in, subscribe, and you can learn more and do it yourself. Otherwise, if you want a shortcut to it, right, this is all I do all day is help people who are in retirement or close to retirement optimize their finances, right? Pay the least amount of taxes over their lifetime, have the most amount of money after paying taxes, investments, estate planning, all that stuff. And so if you want to, there's a link in the description. You can schedule a call or a discovery with me so you can find out, hey, what can we do specifically for you? How does this stuff apply specifically to you? If you're like, I don't want to work with you because this is clearly just a ploy to get your business, and you want to find someone else, that's fine. I always recommend people go to Fiduciary Financial Planning Network. I think it's fiduciaryfinancialplanning.net. We'll have a link for that in the description as well. All the people on there are fee only. They're CFPs. They're tax certified. They can give tax advice. And so if you don't want to work with me, find someone on there and they can give you the shortcut. Otherwise, keep learning if you want to try to figure this out by yourself. Or you can also pre-order my book that's coming out, Tax Saving Strategies. We have another video that we can link in the description at some point that explains more of that. But there's a lot of goodies if you pre-order it. So if you're watching this before March and you want to pre-order, go on there and get those. Link in the description. So hopefully that was helpful, at least, in how to think about, should I do Roth or traditional? We want to jump now into some questions from the audience. And so we will do that. Again, if you have questions, jump those into the chat and we can answer those live. If you otherwise email us questions at retirementorship.com. Okay, let me grab my markers here and we can jump into one of these questions. So let me grab that. All right. So the first, I have two questions that we lined up from different people that emailed for this. Sarah asked, when should I file my own taxes versus like using an H&R block or CPA? And then Mike had asked a similar question, what's the difference between a CPA and an enrolled agent or an EA? And so I thought I'd just kind of combine those into one answer since it's tax season and people are all looking at that. Obviously, it depends on complexity kind of for that first part of it, right? I would say, right, if you are right, W-2s with like a bank interest 1099 and not much else, right, then you could definitely just file your own taxes on TurboTax, H&R Block, whatever else. It's just a matter, right, because they're pretty good at guiding you through, and there's not that much that can happen there. I'm not saying you should always do that or that you should never use a professional if you are in that situation, because there are still surprising things that can happen even for people who think their taxes are really similar. They're still missing out on strategies. Like, yes, you can accurately file your taxes, but if all you do all the time is DIY your taxes, you're probably just missing out on strategies to actually save. It's like, hey, you're not doing it wrong. You're filing correctly for last year, but you're not aware of the things you're missing going forward if you're never working with someone who knows what they're doing and can not only do the tax prep, but the tax planning. And we covered that last week. There's videos on our channel about the difference between tax prep and tax planning. So I don't want to get into that again. But so that'd be the kind of thing. As soon as you get into things like you have rentals, you have retirement distributions, you have Roth conversions, any of those kind of extra complications, you're definitely going to want, especially the first time. This would be a big thing. If you're really like a big DIYer, hey, I really want to do it myself with TurboTax, I would say if you ever have big changes, get a professional to do it the first time, right? If you get a rental, get a professional to do it the first time, and then you can see what they did and do. Like, we see so many people with like rentals and stuff like that they've been doing it for a while and they've been messing something up the entire time. And so don't try it the first time, get some help. The difference between like an H&R block person versus an I'm going to stick enrolled agent in here, put those two together, and a CPA, kind of three things, right? So we always say, right, the base level for anyone is like just like a paid tax preparer, right? And the level that they need to achieve in order to get that is really low. It's not that hard. And so it's basically just internal training from H&R Block or whatever on how to use the software and get things through there. So again, if you just want to dump it off for the cheapest price, you can do that. They don't know tax strategy. They don't know tax planning. They're not going to be able to help with anything besides putting your information in basically TurboTax. And I'm not necessarily casting aspersions on H&R Block specifically, just like discount tax preparers. And so level of competence, level training, not that high. And then you've kind of got the enrolled agent and CPA. I didn't do this well enough, so let's do CPA here. So you got those two. CPA is what everyone is familiar with, right? And these people are super smart. They have way more training, right? It takes a 5-year accounting degree, plus all this extra studying to pass the CPA exam. The CPA exam itself, a lot of it's on like auditing, on like financial statements for companies, and there's some on tax prep and planning. And if you elected the planning specific route, there's a different planning routes that you can go, and this is all kind of a change. Before that, they didn't even have those routes, so this is the new test for them. So some of them can do those things, and they are trained in tax prep. They do know that, but most of their training, I guess I didn't center that very well. Most of their training is on corporate taxes. So they can, like a CPA can run circles around an EA or anyone else when it comes to corporate finance. So like I'm an enrolled agent and I don't know anything about how to audit corporate statements, right? It's not my training. Enrolled agents have a 3-part exam, and that's on personal taxes, business taxes, and like practices and representing you before the IRS. So here would be a big distinction. If you are using just a tax preparer that's unlicensed or doesn't have any specific CPA or EA designation, and they make a mistake, it's completely on you. Like if the IRS sends you nastygrams, they might be able to help you with it, but they can't represent you to the IRS. You need either a CPA enrolled agent or a tax attorney to be able to help you with the IRS. And so definitely you get not only a higher level of expertise, but that actual protection that for someone who can fight for you and talk to the IRS on your behalf, right? And so the enrolled agent has all the training that you should need to actually do taxes, personal taxes, business taxes, and do the tax planning, especially if that is paired like with what we have, where I've got also the certified financial planning, other people on the financial planning, fiduciary financial planning network also have that, right? And so this is like the comprehensive, hey, can do all the financial planning, including tax planning and retirement planning, all those. And you marry that with the enrolled agent, which is here's how you prepare taxes and file those correctly. And that's a good combination for not only do it correctly, but then looking for those opportunities to do tax planning down the road. I will say we occasionally will run into people where, you know, EAs and CPAs will just say, hey, put it all in traditional because you'll pay less taxes, right? They kind of have an incentive to say, you know, pay the least amount of taxes possible because then I get you a bigger refund and you come back to me next year, right? And so they're not always looking out ahead and doing those tax planning where someone who can see the bigger picture might say, you know what, actually, you need to pay more taxes now because it'll actually help you pay less overall, right? Again, back to the tax prep versus tax planning angle that we talked about last week. So I would say, depending on your complexity, right, you would want, if it's very simple, you could do it yourself, or you could have a prepper do it at H&R Block. But for the difference, you're probably better off just having a real CPA or enrolled agent do it. We do taxes as well. We do one-off taxes if you just want your taxes done. We do taxes of our clients, so people that work with us on a total comprehensive capacity get their taxes included, and we prep those with tax planning in mind. But hopefully that just helps explain kind of the difference between the different levels and when you might need one over the other. So I would really encourage you to find someone who knows tax planning and tax prep, is good at all that stuff, and how all those things fit together. So again, if you've got questions, send them to retirementorship.com. And we'll see you next week where we'll talk about Roth conversions. Okay, hey, maybe it's too late to do Roth contributions. What if we need to convert? And what's the best strategy to do that? And how do we know if we need to and how much? So we'll cover all those principles next week. We'll see you then. Take care. Cheers.